Today we're looking at the Betashares Nasdaq 100 ETF, NDQ. We'll look at how much dividend income it provides each year, dividend yield, payment frequency, total performance, and the management fee. NDQ is an ETF provided by Betashares, who own and operate the fund. Betashares are the ones who own the underlying shares in each of the individual companies. So when we buy shares in the ETF, we buy from Betashares, who continually issue new units in an open-end fund, and not the individual company shares inside the ETF. NDQ tracks the performance of the Nasdaq 100 index, providing access to the performance of the 100 largest non-financial companies listed on the Nasdaq. The fund and the index are rebalanced quarterly and reconstituted annually, which means companies are removed and added to the index in the correct weightings in the index and ETF. This ETF suits buy and hold investors, primarily seeking long-term capital growth with some dividend income. It pays distributions, which are dividends from the ETF, 2 times a year with a yield of 2%, which would equate to $2,000 worth of income for every $100,000 invested. It has a management expense ratio of 0.48% per year, so for every $100,000 invested, it will cost $480 per year in fees. This is automatically subtracted from the ETF unit price, so you won't actually see any fees being taken out of your brokerage account. Since NDQ tracks the Nasdaq US market, it is heavily concentrated towards technology companies. The largest portion of the fund, at 49%, is in tech, followed by communication services at 15% and consumer discretionary at 13%. Utilities, energy, and material companies make up the smallest percentage of the fund, under 2% each. Since inception, NDQ has had an average annualized return of 19.2%, which includes both capital growth and dividends. Past performance is no guarantee of future performance, but it's a good sign of improving business fundamentals, continually driving each individual stock higher within the ETF. With dividends reinvested, the cumulative return becomes much better. Reinvesting these dividends creates the larger compounding effect, exponentially increasing our returns the longer we have our money in the fund. This is the approach I take investing for the very long term using ETFs, to one day live off the investment portfolio as passive income through dividends or selling down small parts of the position.